Hey everyone, this is Mike. The title of this podcast is Do I Need to Report Bitcoin on my FBAR? This is far and away the question that I get asked the most when I'm doing a legal consultation for a client who has cryptocurrency or Bitcoin. So, the explosive growth in the cryptocurrency sector has created these questions about tax compliance. It's caused a lot of taxpayers to be on edge. Now, what we have to guide us is a guidance that was issued by the IRS back in 2014. It's called IRS Notice 2014-21. And back in 2014, it was considered a long awaited guidance. And basically, what it said is that it labeled cryptocurrency, including Bitcoin, as intangible properties. What this means is that investors and traders hold Bitcoin as a capital asset, just as if it were a precious metal or a corporate stock. Because it's a capital asset, this triggers a lot of tax issues. The IRS requires American taxpayers to report the Bitcoin trading income and losses worldwide on their U.S. resident tax returns. In other words, if you trade Bitcoin, you have to report capital gains and losses to the IRS. It doesn't matter whether or not you repatriated the funds back to the U.S. or not. Now, to get into a little bit more detail as far as accounting goes, investors and traders holding cryptocurrency should use capital gain or loss tax treatment on sales and exchanges with the realization method. Now, I realize that might sound like mumbo jumbo, as the realization method isn't something that is well known to people outside of the accounting profession. But to give you a quick and dirty example of the realization method, if you buy Bitcoins with US dollars and you later sell them for US dollars, a capital gain or loss needs to be reported on that transaction. Now, I also recognize that Americans trade Bitcoins on Bitcoin exchanges, and they should report realized capital gains and losses on each trade, even if the trader doesn't convert the underlying Bitcoin back into US dollars. This is similar to having a foreign-based brokerage account in a foreign currency, such as euros, where a trader buys and sells European equities held in euros and doesn't convert the euros back to US dollars during the year. There are primarily two choices for tax reporting in that situation. First, convert the Bitcoin to US dollars on each purchase and sale transaction using the Bitcoin market price that day in US dollars. Or second, use Bitcoin as a functional currency using an average Bitcoin versus US dollar conversion rate for the tax year. Again, if this sounds a little bit like mumbo jumbo, you can certainly ask your accountant for more specific information about the mechanics involved in these two choices. Now, I'd like to turn to Bitcoin and foreign bank account reporting for a second, just to rehash the rule regarding foreign bank account reporting and what triggers an FBAR or FinCEN Form 114 report. U.S. residents with a foreign bank, brokerage, investment, and any other type of account, including retirement and insurance in some cases, who have assets that exceed a certain threshold, namely $10,000 US, in the course of the year, are required to report that foreign bank account on an FBAR, or what is collectively known as a Form 114. And this is called the Report of Foreign Bank and Financial Account. So if the aggregate or combined value of all of your foreign bank and financial institution accounts falls above the threshold of $10,000 at any given time during the tax year, that triggers an FBAR. And essentially, you have to disclose those accounts on a foreign bank account report. So theoretically, you could have, say, 5 or more accounts with balances that are below the $10,000 threshold. But if the combined value, meaning by adding the high watermark balance of each account, if that high watermark value exceeds $10,000 at any given time during the tax year, then all of the accounts have to be disclosed, notwithstanding the fact that not one of them alone exceeds the 10,000 threshold. And again, as far as the conversion is concerned, the conversion rate that is in effect as of the last day of the tax year is used to convert foreign currency into U.S. currency for purposes of determining whether the threshold has been eclipsed. Now, just like foreign account holders don't have to report precious metals in offshore safe deposit boxes, the conventional wisdom was that taxpayers also don't have to report Bitcoin in virtual wallets. This was the view that IRS analyst Rod Lundquist espoused back in June 2014, a date that seems like light years ago now. Now, a lot has changed since then. While the IRS allowed taxpayers to exclude Bitcoin from their 2013 foreign bank account filings, it's not clear, and I repeat, it's not clear if the IRS continues to allow an exclusion of Bitcoin or Bitcoin derivative contracts on current year FBAR filings. And so what I've been advising my clients is that due to the staggering FBAR penalties for non-compliance and the ever-changing landscape, out of an abundance of caution, I've been recommending to my clients that they include their Bitcoin accounts on FinCEN 114 or the FBAR. And again, even though there has been no solid ruling on this or directive from the IRS, this is a very volatile area, and the landscape just continues to change. And so out of an abundance of caution, it's being recommended, at least by me and other tax lawyers, that these Bitcoin accounts be reported on FinCEN 114. If you have any questions, feel free to get in touch with me anytime. My door is always open. You can check me out online at my website at www.deblisslaw.com or connect with me on LinkedIn.